Welcome everybody to video one of understanding the 15-minute range. This is going to be an in-depth tutorial, in-depth class, free class on the strategy that I use that's helped me to become a better trader in the day trading market. It's going to be a disciplined approach to understanding the trend, the volume, and to definitely execute on our day trades. I've been using this strategy for the past 2 years. It's been a strategy that has been growing on me so much. It's been my go-to strategy. I've tried supply and demand. I can't not understand ICT. So the 15-minute range is so simple, it's ridiculous. But I've added on a few things that have definitely helped me with my own trading psychology and my own process to becoming a better day trader. And with this strategy, right, I'm going to be breaking down everything, my indicators, my risk management, all of my indicators that I use. I'm going to break down everything that you need to know. That way, if it does help you, then to me, that's all that matters to me. But with this one, right, we're going to talk about what is the 15-minute range. Let me do a full presentation for y'all. That way, y'all can see everything. The 15-minute opening range is the high and low prices established during the first 15 minutes of the market. Now, I trade the New York session. So for me, that's the 9:30 to 9:45 candle. For the Asia session, that is the 6 p.m. Eastern to 6:15 Eastern session. This range, as I've learned and what I've noticed, that it acts as our roadmap. It represents the initial battle between buyers and sellers. The strategy isn't new at all. I learned this from somebody else who learned it from somebody else. It's not a new strategy. I've just made changes, but I'm also just showing you how it works for me. Now, this works with futures and stocks during any session of the day, whether it's the New York, the Asian, or the London session. With this strategy, there is no guessing. We trade the same repeatable setups and we react to those setups. Defining our bias. If price breaks and holds above the 15-minute high, the bias for the day is considered bullish. If it breaks below the 15-minute low, the bias is bearish. It's that simple for me. Now, let's talk about the range and support and resistance, right? Now, throughout the day, the highs and the lows of the opening range often act as hit levels where price may stall or bounce. Another strategy that I used to trade is the opening range breakout. They call it the 15-minute orb because it's the opening range breakout. I just call it the 15-minute range because I used to trade the breakout a lot, but market conditions definitely told me to avoid that and to adapt to the market. But the opening range break is a popular strategy where a trader enters a position the moment prices crosses the 15-minute boundary to the upside or to the downside, betting that the initial momentum will continue in that direction. And that's all we're trading. We're trading the trend and we're trading where the market wants to go. Failed breakout. That happens sometimes too, which is why breakouts are high risk trades because most of them are fake outs to shake out retail traders like me and you. This is where the price pokes above the 15-minute high, but immediately crashes back inside to the upside or to the downside. This is a strong signal that the market is exhausted and is tired, and a reversal might be coming. Well, as I said, it's a fake out breakout. For this strategy needs momentum to work with active buyers and sellers. But most importantly, this strategy is going to teach you how to be patient because you're not trading just anything you see. You're trading only your setups within your criteria. Now let's talk about the 15-minute range. This strategy is all about patience, as you have to wait for your setups to appear. I don't trade every single move in the market. I only trade 1 to 3 setups. If I don't see a setup, I do not take a trade. That's how trading is supposed to be. It's supposed to be boring. You're not supposed to trade just to trade. You're supposed to trade the same setups over and over again. You have to know where your edge is in the market. If you cannot define your edge, it's going to be hard for you to become a profitable trader or to at least learn from your mistakes if you're not going back. No, this strategy isn't foolproof. No strategy is. The only thing you can control is your risk in trading. We might have the best setups. The only thing we can control is our risk, how much we put on per trade. The market's going to do what it wants to do. It can invalidate all of our setups for an entire week. But if we don't have the proper risk management, we'll blow up every single time. And that's on us. So for the 15-minute range, we wait 15 minutes. That's right, we wait. We just watch the market and we wait. And we mark out the first 15-minute candle high and low of the candle. including the wick, because the wick is important as well. The entire body and wick of the candle tells a story. Now, there are three parts of the range: the bottom of the range, which can act as support, and the top of the range, which can act as resistance, and also the midpoint line. This is the 50, this is the half retracement between the high and the low. Or to me, the midpoint is at least halfway retracement between the high and the low. This is a hidden support level resistance. The midpoint, the 50% retracement level between the high and low, this is a hidden support and resistance level that many traders miss. I used to miss it as well, but I only use it for the trend confirmation. Now, let's talk about the trap zone. Most traders, like myself, we have all fell inside this trap as we try to trade inside the range, and we don't wait for confirmation. Professional traders wait for the first 15-minute candle to close to see who won the opening battle. Now, we don't trade inside the range. We wait for the range to be broken and we look for confirmation. Because inside the range, usually, if we don't break out, that means two things. There's not enough price action and volume to push us out of this range, or they're waiting for something. It's our job to just wait and to see who's going to take control, because anything can happen inside the range. But once we get outside the range, we know exactly who has full control. So let's go to the charts now. We're going to just show you the 15-minute range. So we have this session from Friday, March the 20th. Let's go here. We have this right here. This is the first 15-minute candle. It started at 9:30. It closed at 9:45. This is the first 15-minute candle. As you can see here, we're on the 15-minute time frame. What you see in the blue shade right here is the pre-market price action. It's important, but the 15-minute range starts right here. I'm going to draw a box right here around the candle, just like that. From the bottom of the wick, it's important too. It tells a story to the top of the wick. This, let me do translucent, that way y'all can see it. Let me stretch it all the way out. Now, what do we see here? So it started off bearish because it's a red candle. Sellers try to take us low, bulls try to take us up. So the bottom of this range here is going to be support. Let me go to 5-minute. That way we all just see this. As we see here, we just went up and down. All this is noise because there is no trend confirmation. But once we broke out the range, bulls tried to step in here on this big green candle. Let me turn my volume, y'all can see it too. So sellers took control here. And then bulls said, no, I want to go up. But who ultimately took control? It was the bears, because we broke below this level of support that the bulls tried to hold, and we went lower. This told me that sellers were in control. Once we break out either side, we can see who's in control of the market, y'all. And that's the 15-minute range. It's simple. It shows us trend direction and what we must look out for.